Mortgage rates posting a big jump last week as Treasuries sell off on signs of a strengthening economy. CNBC's Diana Olick is live in Washington with the details on this mortgage rate story. Hello, Diana.
Hello, Larry. You know, we haven't seen 5% on the 30-year fix since May 12th, but that's what we saw last night on the bank rate overnight average, and it's all thanks, as you said, to the 10-year Treasury. The big question, of course, is how is this going to affect the housing recovery? Well, think about it this way. Just a couple of months ago, we were down below 4.25%. Now, if you do the math on a median-priced home around $200,000, putting 20% down, your monthly payment is still going to be less than $100 different when you go from 4.25% to 5%. The issue in this market is still really credit.
Banks are absolutely tightening up on standards. There's no doubt about it, in a counter-cyclical way. Of course, they should have been tightening before. But if you have the credit, Fannie Freddie loans are still out there. They're long-term rates, and banks are making those loans. Of course, you do have to have the credit.
Now, refis are really most affected by rising rates. You can see in this the direct correlation here of how applications rise as rates go down, and of course vice versa. Now they've turned down especially because many borrowers have already refied at 5%. Now, mortgage applications to purchase a home are a little trickier, but as rates started to rise dramatically in the last month, purchase apps also actually rose because some buyers jumped off the fence, concerned that they'd better get in before the rates go any higher.
We've seen a lot of movement in a very short period of time, and so the likelihood is that rates aren't going to keep going up at the same pace. If anything, they may level out at this particular point, but you can kiss those record low rates goodbye unless the economic recovery completely fizzles.
Now, for most home buyers out there, this small change in the rate isn't really going to affect their buying power that much, especially if they're over the median priced home. But what it is a real psychological barrier, especially for folks who are thinking about jumping into the market this spring. They got to wonder, where are rates going to be going over the next couple of months? Should they put their house on the market now if they want to trade up in this spring? Again, it's going to be a real tough choice when they see the rates varying around so much like this. We've got a great discussion about this going on the blog. Go to it, realtycheck.cnbc.com. Larry?
Diana, just a quickie on this. I like this jumping off the fence. In other words, is it possible that the movement of higher mortgage rates will get people going, whereas they were shilly-shallying and tallying around and waiting to get the absolute bottom? Now they got to, you know what, or get off the pot.
Well, you know, we did over the last couple of weeks see the purchase applications going up, even as the interest rates were going up. That is, applications to buy a home, for a mortgage to buy a home. And I was wondering, why was that happening? And folks said, yeah, people are worried. They want to get off. They want to get that rate. Buy the home now that they were kind of waiting around for, because, you know, in a buyer's market, you don't exactly have to rush to buy. But it seems like once we've hit the 5%, we did see the purchase applications reported today dropped last week. And that's concerning because sometimes, again, you hit that emotional barrier.
All right, Diana Olick, thank you very much. We appreciate it. So the 10-year Treasury is up over 100 basis points, now crossing 3.5%. 30-year mortgages have jumped to about 5%. So is this going to kill any sort of housing recovery or mortgage refinancing? Let's talk to Stephen Gandel, senior writer for Time Magazine and author of the article, Will the Tax Deal Hurt Housing? And Matt Englett, managing partner of KEL Attorneys, one of the top foreclosure attorneys in the U.S., defending over 10,000 clients. Oh, my God, I still can't get over that, Matt. Okay, Steve Gandel, let me bring you welcome back to the show. Welcome to the show.
Nice to see you, Larry.
Give me your take. You have a very contrary view. You're basically saying the tax cuts and the higher rates are not going to stop the mortgages.
Well, you're right. The conventional view is higher interest rates mean higher mortgage rates mean people will buy fewer houses. But if you look over the long haul, there's no real correlation between interest rates and housing prices. The thing that correlates with housing prices is jobs. If I don't think I'm going to have a job, I'm not going to buy a house. If we really believe that interest rates drove housing prices, then we would have seen housing prices shoot up over the last year. And we haven't seen that as interest rates have come way down.
You know, Matt, that's pretty interesting logic. And I just want to add one little layer to that. The reason perhaps that rates are going up in the Treasury and the mortgage market is tax cuts driving up economic growth. But isn't that going to give people more resources and more income to afford a home?
Well, it could, but I don't think, I think the argument that rates going from 4 to 5% is going to have any impact on the housing market. I think Diane is right in her piece. I don't think it's going to have any impact on whether or not people buy. That's still historically a very low rate. I think what will have an impact is if for whatever reason, the rates continue to go up and rates hit 7 and 8%, that is going to slow down the real estate recovery drastically.
But nobody's talking about 7 or 8% right now. I mean, we just got to 5.
You wouldn't have 7 or 8% unless you had massive economic growth, and then people would have lots more money. They'd be able to buy more houses.
Stay with that, Steve. All right, more money. They'd have jobs, better paying jobs, more incomes. Presumably, not only does that allow them to buy more, that gives them better credit. So take 7%. That's a good outlier, Steve. Would your view hold at 7%?
My view would hold at 7% if we had an economy that justified 7%. If we had no growth in 7%, which I don't think is likely, then yeah, I agree. The housing market and the rest of the economy crashes.
All right, Matt. What's wrong with that logic?
No, listen, I think that he's missing the point. To sit there and try to make the argument that rates have no effect on whether or not people want to buy a home is absurd to me, because we know that when rates are low, people are more apt to get off the fence and purchase a home. If rates are high and going higher, people are going to hold off and wait a little bit. Just because they have the money to do it does not mean they're going to jump off the fence and buy.
Why wouldn't they come in sooner? I don't understand your logic. If you think rates are going up, why wouldn't you come in sooner?
I think the reason why people aren't coming in sooner is because we're still in a declining market. People think, rightly or wrongly, rates are going to stay low, and they think that the real estate market prices are still going down, and they want to see how that goes through 2011 before they start to buy a home.
Steve, give you the last word.
No, I agree with you on if housing prices continue to fall and people think they're going to fall, then you're right, they won't buy a house. But rising housing prices and the better jobs, that's what drives the housing market. Interest rates rose through the 2000s when we had a big, huge bubble in housing. So over the long haul, there's no real evidence.
Rose to what?
Despite
6%?
All right. I got to leave it there, gentlemen. Thank you very much, Stephen Gandel. We appreciate it. Good to see you, Matt Englett, as always.